Jay Powell is probably not a Volcker, but he's treading a similar path. But the Fed is going to try and break the system. That's what it typically does. It needs to get inflation down. It can't act on supply. It can only act on demand, and that's what it's focused on. And I'm absolutely sure you're going to get a recession in the US, but believe me, the recession in the rest of the world may well be a lot worse. But at the end of the day, what we're in is a cycle of QE and QT. And way back at the time of the 2008 crisis, we made what appeared to be a heroic statement or assumption then to say that, look, this is not just a one-off QE. You're going to start seeing QEs like a bottle of pills. Okay, one is labeled QE1, the next one's QE2, QE3. Central banks are here for the long term. And what investment managers have got to realize, as a heads up for this, is that the Federal Reserve and central banks are in this game for the long term. If you look at the projections that the New York Fed makes, long-term projections about what the SOMA account, which is the system open market account that the Fed uses to purchase treasuries, that account is going up to 7 trillion again within the next 5 or 6 years. Okay, it may go down to 5 or 6 in the near term, but they fully expect it to pick up again. So central banks are in the markets long term. If you fear markets are distorted by central bank action, well, welcome to the new world. They're here for good.
So in the last Fed meeting, with the directive, they issued the dot plot. And on the dot plot, the highest dot on the dot plot was 3.5% Fed funds, which I believe was like 1 year out. That was the highest dot. And today we have terminal Fed funds at about 3.84%. Okay. Mm-hmm. So obviously the market thinks that, and that was the highest dot on the dot plot. If you had to guess what terminal Fed funds would be, what do you think it would be?
3%.
3%.
Yeah. I think they're going to get nowhere near the expectations that the market has. I just don't think they can push rate increases through fast or aggressively enough without derating the economy, because what you've got to remember at the same time is they're actually shrinking the balance sheet. And the balance sheet shrinkage means a lot more in terms of the stability of the financial system as well. So these two factors combined, you're going to start to see a very significant recession unfolding, and the Federal Reserve will get spooked. So inflation may well come down, but I think people are asking, with all due respect, the wrong question on inflation. It's not when inflation peaks that is the key thing. It's when inflation comes back to a sustainable level. And what we've got now is a lot of persistence in the inflation rate. If you do very simple calculations of US inflation, you'll see that the pass-through from month to month is up at the same clip that it was at when Volcker came into the Fed in 1978. He came in to kill inflation, and he did that. But you've got to remember that Volcker created 2 recessions in 3 years to get there. Okay, Jay Powell is probably not a Volcker, but he's treading a similar path. But the Fed is going to try and break the system. That's what it typically does. It needs to get inflation down. It can't act on supply. It can only act on demand, and that's what it's focused on. And I'm absolutely sure you're going to get a recession in the US, but believe me, the recession in the rest of the world may well be a lot worse because the dollar's going up at the same time. And that's not good for international borrowers.
Well, from a trading standpoint, I'm looking at March Fed funds right now, March of 2023. They're trading at 96.26, so 374. So if you think that terminal Fed funds is going to be 3%, those would be a screaming buy for sure.
Yeah, I think that's right.
And with tens at about 330 right now, I mean, if you think there's going to be a recession, the long end should rally pretty significantly. I think tens would get to 2.5, 2.25, something like that. That should also be a screaming buy.
Yeah, I think that's right. I mean, I'd lean more towards the funds market for the simple reason what you've got are 2 headwinds which are very unpredictable. One is Japan, and the other is Eurozone. Now, if you start to let's look at the Eurozone, because that's a basket case, but it's easier to think about. What you've got in the Eurozone is basically a fragile and unstable system, okay? It was designed by politicians, and that's always a mistake. The problem with the Eurozone is fundamentally this, that Italy, to take one example, accumulates debt, okay? It can't avoid accumulating debt. It's got deep structural problems. And Germany spends all the time denying the liability for that debt, okay? In between, you've got the European Central Bank, the ECB, who will pump in liquidity to paper over those cracks. the COVID-19 emergency gave them the excuse to paper over a lot of cracks, and they pumped in a lot of liquidity, and you avoided fragmentation in the Eurozone bond markets. Effectively, they could buy across the board bonds and they could pull spreads in. If you get a different regime where you've got to protect financial stability in an environment of rising inflation, good luck with that. Because if they're going to have to tighten, they can't maintain spreads and you'll get fragmentation in the Eurozone. And the fundamental problem that the Eurozone has is there is no safe asset, okay, outside of the Bund. And if you look at what the Bund is doing now, it's not behaving very well. So these other bond markets are in a really, really difficult situation. How the ECB gets out of this, I just don't know. It can be a very, very serious problem unless the euro weakens substantially, which I think is a high risk, and or inflation picks up. And inflation picking up may not be acceptable to Northern Europe. So that's the European situation. You know, as they say, the Irish joke about travellers. You know, a lost traveller. If you want to get to Dublin, I wouldn't be starting from here. And that's the problem a lot of central banks have got. They made a mistake 5 or 10 years ago when they basically mistook structurally low cost inflation coming out of China because of China's entry into the World Trade Organization for monetary deflation. And what they did is they slashed interest rates fearing monetary deflation, when in actual fact what they were looking at was cost deflation. And they should have done nothing. They should have actually kept rates moderately high. As they slashed interest rates, what did you get? You got this avalanche of debt accumulation, or mountain of debt accumulation, to mix my metaphors. You got this mountain of debt accumulation. What we've got in the world economy now is $300 trillion worth of debt. The average life of that debt is 5 years. So simple math says that you're going to have to roll 60 trillion of debt every year, okay, as that debt matures. That's an awesome amount of money. Now, we're told by economists and central bankers that the financial systems are new financing systems. They're all about raising capital. Wrong. They're about refinancing debt now. So the debt load, the debt burden on the markets are 6 times the new capital issuance, okay? So you're rolling at least 60 trillion of debt every year, but you're only delivering about 10 trillion of new issuance, which is about half global capital spending. So capital markets are actually refinancing mechanisms, not new financing mechanisms. Now, if you're in a new financing mechanism, interest rates matter. But if you're in a refinancing mechanism, hey, it's all about liquidity and balance sheet. You know, from your trading sample, you understand that this is key. Market depth, you want capacity. And if you can't get the capacity, you get problems. And the issue is that the central banks are now controlling balance sheet capacity in the financial system by their movements in their balance sheets. So what the Federal Reserve is basically is now hooked on expanding its balance sheet over the longer term to increase financial capacity. And so these wobbles or these cycles in central bank liquidity, which are being triggered by inflation concerns, are going to cause whopping great cycles in financial markets. And that's what we're facing. It'll rebound again. Look, I'm saying to people, you know, don't sit on the sidelines now. But hey, there's a fantastic opportunity in 2023 to make an awful lot of money here. But you don't want to, you know, burn your powder now because there's a problem. Markets are going down. You still got a big correction. I mean, we put a chart in a little bit later in the presentation I think I sent, which is looking at the average S&P 500 index performance against US liquidity. Now, if you look at that, there's a very clear relationship, and this data goes all the way back to 1970, and it looks at an average cycle. And what it says is that you've got to expect from peak to trough over a 30% drop in the market, and that's a normal correction with a liquidity squeeze and a recession, and that's what we're getting. Okay, first leg down 25%, 10% rebound, second leg down another 17%, okay? Then you start to get some big upswings, 27% bounce from the bottom, pause, then another 15% up. And these are the sort of things, magnitudes you've got to start thinking about as to how the cycle will unfold. And what turns the market is the Federal Reserve coming back and starting to ease aggressively. Now, I think you're right, Jared, that what's going to happen is the unemployment number is going to spook politicians and bankers come early 2023. And they're going to turn around. They're going to start picking up a bottle of QE pills again and downing them. And that's what we've got. But, the US is one country here. It's a big and important country. But you've got to start thinking about what's happening elsewhere in the world, what's happening in China. Now, the straightforward way we try and analyze this is to say, look, you've got two moving parts in the stock market. You've got the PE and you've got the E. Well, who dominates the PE? That's the Federal Reserve, okay? The Federal Reserve, crimps money, the PE will derate, the PE will drop. But if China starts to squeeze, China's footprint in the world economy is enormous, as we know. That will kill the E. So what you're getting at the moment is, is both areas. You're getting the PE going down because the Fed's tightening aggressively, and you're also getting the E potentially going down. It hasn't really happened a lot yet, but it will do because China is squeezing as well. Look at some of the numbers that were coming out of Target and Walmart a week or 10 days ago. They're talking about inventory levels up 30 or 40%. I think Abercrombie was up 25%. These are big, big numbers. And you're talking about, recession coming and earnings getting absolutely crunched here. China is tightening. And why is China tightening? Because the yuan is very weak. And why is the yuan weak? Because of what's happening in Japan. And what you've got is the yen is weakening substantially. The Korean won has gone with the yen. That's weakened too. And that's putting huge pressure on the Chinese yuan. Consequently, the People's Bank of China are tightening. Now, normally in April and May of a calendar year, the Chinese People's Bank normally dishes in huge amounts of liquidity into the Chinese markets. That's their seasonal pattern. What did they do the last 2 months? They took out 800 billion yuan, $120 billion. I mean, this is not a central bank that's easing, believe me. And that's going to have detrimental effects on the Chinese economy.